clients and friends of MBP Sterling Partners. It's Jamie. I'm back in audio format only today to give you a Q1 update and a Q2 outlook. That is to the extent that Q1 even matters anymore. So what have been our themes so far for 2025? Well, certainly uncertainty is top of the list. Policies flip-flopping all over the place have caused a lot of market gyrations, especially in the past couple of weeks. US yields have topped out and started to decline. But wait, no, now they're bouncing back up. So again, flip-flopping is causing some wild markets. US dollar peaks and declines. Equities have started to struggle, and the rest of the world is waking up. So let's have a look at where we go. In Q1, equities had a good start, but they turned around. We did see some strength in Europe, in global real estate in particular, but most of the world saw some declines. Canada eked out a little gain. As you can see, the sector returns here with materials and healthcare leading the way, and technology and consumer discretionary lagging. What's really interesting is the US versus the rest of the world, which the rest of the world has been on a tear. You can see this bottom right chart, the developed world less USA. That's the ratio between the two. And being in the rest of the developed world minus the US has been a good place to be. But let's zoom out for a minute. That's one quarter's market action. If we go back all the way to the great financial crisis, 2007, 2008 era, you can see that US has absolutely trounced the rest of the world. So is this a short-term turnaround, or are we seeing a long-term change in global market leadership? Over the past many, many years, there have been periods as long as 10 years where the US has been underperforming the rest of the world, including Canada. And we are open to the idea that there might be some change in leadership going forward. We'll talk about that a little bit more. In bond world, well, we see US yields finally start to decline a little bit. That peak is at the start of the year, and you can see a pretty steady decline in the US 10-year and 5-year yields. That is finally joining Canada, and so that widening of yields between Canada and US has stopped somewhat. There's still a big gap. It's bigger than we normally are used to seeing it, and that is something that you may know we watched closely as an indicator of where the Canadian dollar is going. But of course, this has gone wild in the last few weeks as well. We're just looking till the end of the quarter right now. We'll catch up on this looking forward. The US dollar had a very weak quarter, and you can see in the bottom chart here the returns of various currencies versus the US dollar. The Canadian dollar was exactly flat over the quarter, but the US dollar posted losses against virtually all of its other trading partners around the world. We watch natural gas and crude oil closely as indicators of the Canadian dollar, but neither of them really gave us any indication that we should be looking for any leading strength going here. And what are the strategists telling us? Well, this is earnings growth expectations for the US, Canada, and the rest of the developed world in orange, purple, and gray, respectively. And as you can see, analysts are still relatively optimistic. They're still expecting about 10% earnings growth for the US for this coming year. That's 2025 by the end of the calendar year. But what's coming? We all know that we're going to talk on tariffs, and that may materially change what the earnings outlook is for the rest of the year. So let's get into it and talk a little bit about the outlook. Let's pull up our outlook slide from Q1, a few of the bullet points that we brought up and talked about, and give ourselves a little bit of a scorecard. So what did we talk about earlier this year? Firstly, policy volatility. We'll give ourselves 2 check marks for that one. Don't think it could have gotten any crazier than it's been in the last few weeks. Higher interest rates. Well, on the long end, we saw that. They peaked out and have started to decline. Rate divergence, that has actually held up. So we still see Canadian rates that have fallen just as much as US rates, and that divergence has stayed pretty strong, even though the loonie, as we'll get into, has narrowed its gap. Really, that's a US dollar story. Tariffs, immigration, and fiscal deregulation, I think that's all been bang on. Those weren't hard to call, and Trump has gone into action in his first quarter in office and made some pretty huge policy changes. Country focus, will the US continue to dominate? We're going to talk about that a little more. No conclusive answer on that. We may not have that answer for many quarters or even years. And as for the investment themes, well, to be honest, we've thrown a lot of them out the window. Tariffs have stolen the show, and we've stopped talking about the positive or optimistic outlooks towards various themes. They may come back, so we won't fully give ourselves a miss on these investment theme calls. But for the time being, the market is just not focusing on. Well, let's look at Canada. Much like any policy, these poll numbers for the current federal election coming up will be wrong by the time you're reading this or listening to this presentation. But this is where they stood today. We saw wild swings in the polling of this upcoming election from prior to the election being announced when Trudeau was still in office to Carney taking over as the Liberal leader. And now that gap is starting to narrow again. So what we've seen is a narrowing of Liberal conservative gap. Liberals were well in the lead, and now this is narrowing. And of course, if you go back to our last quarter's presentation, we were optimistic that change coming in Canada was going to be good regardless of which party takes control. But we're getting a better idea of what the platforms look like, and we have a little bit better of an idea of what those policy changes will look like. For those who haven't discovered it yet, the election platform artificial intelligence tracker at 2025.buildcanada.com is a really interesting place to go and see various election platform promises and compare the two primary candidates against each other. But what about rate expectations? Well, they are coming down, but not as much as we might have thought. Interest rate traders and those trading the overnight index swaps that set these central bank expectations are just as confused as the rest of us. And so while terminal rate expectations have dropped a little bit, we're now aiming at about 2.25 to 2.5 for Canada versus the current 2.75%, and a little higher at 3.75 to 4.25 in the US versus the current 4.25. Those come off a little bit, but the rate traders are just as confused as everyone else. And the implementation of tariffs and the change in the world global trade patterns are going to have a lot to say about where interest rates are going. Well, what about this dominant America theme? It's been prevalent for many, many years, a couple of decades even, and now we're seeing perhaps the changing of a world order. So we wanted to remind everyone, this is with the help of the Alliance Bernstein, where we source this data. We want to remind everybody that America has not always led. There's been periods of time where the rest of the world, and by this we're looking at the EFI index, which is Europe, Australasia, and Far East, so the developed world ex-US. There have been times when the EFI index has led in earnings growth quite considerably. So if we look at the 70s and 80s, for example, we saw big growth outside of the US. And US growth wasn't bad either, just didn't approach where the rest of the world was. And over the decades, through the 90s, 2000s, 2010s, and 2020s, the US started to really hold up, not even really accelerate that much. They did slightly better through the 2020s, but it was really the rest of the world that was declining that created the US outperformance in the markets. So where are we now? Looking to the right here, consensus earnings growth for America versus Japan, Europe, and the emerging markets, they've narrowed a lot. And you can see US expectations are not that far in excess of Japan and Europe at 11, 9.5 and 9.6% respectively. And yet the US price earnings ratio, the markets in the US trade at a considerably higher PE multiple. Now, maybe that's justified because the growth in the US can be more sustained than elsewhere, but this is part of the valuation gap that has us scratching our heads a little bit and wondering whether that era of US dominance might be coming to an end. Another interesting fact that we've seen come about because of all the tariffs and the policy flip-flopping is our typical safe havens haven't been all that safe. So normally when we see global equity markets start to decline, people run towards the US dollar and people run towards US Treasury bonds. Well, as we can see here recently, and this is just since the end of the quarter, so an April only phenomenon since the tariff wars have really gotten heated up, that April 2nd Liberation Day, as Donald Trump called it, you actually see 10-year yields have climbed quite a bit. So 10-year Treasury bonds have declined in value. Meanwhile, the US dollar has also declined in value. So this is pretty rare. We don't actually see these two indexes go in opposite directions. So both these safe havens have actually been losers as the equities have declined. Where is their safe haven now? Well, I don't really want to call Bitcoin a safe haven. It's a massively volatile asset that has been correlated to risk assets quite a lot. But people like to talk about it, so we thought we'd bring it up here. And of course, gold. Gold is regaining in popularity as it hits new all-time highs. And gold has been a decent place to go and hang out. It's where the world has sought some safe harbor from all the volatility in all the different markets, whether they be interest rate or equities recently. Well, what about in Canada? We talked about the loonie. The loonie has felt strong recently, but that's because you're looking at it against the US dollar, which has been really weak. We actually look globally against the euro or the Japanese yen. The loonie has been quite weak. There are a few strong stories against smaller currencies that have done even worse. The Canadian dollar against the Aussie dollar or the Norwegian krona has been strong, but really against major other currencies outside of the US, the loonie has been weak. And that's a global view of Canada's trading relationship with the US having soured somewhat. No fault of our own, of course, but we have seen the world sell loonies relative to euros and Japanese yen as a result. So what about the economy? Well, we're looking at Canadian GDP. That doesn't tell us a whole lot because it's so backwards looking. You can see it has stabilized, but in compare to what we call the US GDP Now index, and GDP Now is a real-time index of where expected GDP will come in. And you can, as you can see, it's quite volatile, and it certainly doesn't represent where GDP actually goes, but there is a correlation between where GDP Now goes up and down and where Canadian GDP ultimately ends up landing. So the GDP Now index has fallen into negative territory recently. This is on the back of all the tariff talk. And GDP Now measures real-time spending, so we're actually seeing some spending decline. So this is something to watch. It's not an alarm bell yet. As you can see earlier, GDP Now has dropped substantially before without having the Canadian GDP follow it, but it's something that we're watching closely. Recession probability in the US, this indicator doesn't exist for Canada, so we use the American one. It has finally started to tick up a little bit. That's for the end of March data. We expect that the April data, when it comes in once a month format, we expect that it will tick up considerably again. Most economists will tell you, and I am one of those, that tariffs and global slowdown in trade are going to cause some recessionary impulses. Tariffs simply raise prices for everybody, and that means people will buy less. So what about employment? Well, US is holding up pretty strong. Canada, as you can see, this is turning into a relatively long-term phenomenon of increasing unemployment. So this is part of the reason why you see some, or you feel some unrest and some tension in this election. It is certainly what came to hurt the Trudeau administration. We've seen unemployment rate in Canada ticking up for the better part of 3 years now. So just under 7%. We're watching this one closely. Canada's had a hard time creating and maintaining jobs in the last couple of years. So we used this chart, this exact same chart last time, but it is a very long-term chart, and we just want to remind everyone, because of all the volatility we've been seeing lately, we recognize that it is hard. As we sent out a note earlier this month, it is different this time. It's different every time. There's always a reason, and as you can see on this chart, if you want to pause the video and zoom in, there's many, many reasons here where it is different this time, but ultimately the markets have prevailed. Businesses do what businesses do, which is optimize themselves for the current conditions and the current set of rules once those set of rules are known, and try to maximize their profits. So we have strong faith that the businesses that we invest in will continue to do that in the long term once the set of rules is known. And we will look back on this tariff and trade war much the same way as we look back on many of these declines in the past 30 years that we're looking at on this chart. You could do this chart going back considerably further and have a similar number of reasons to sell. But at the end of the day, really, there are reasons to reallocate and rethink the way that we're investing, but they are not necessarily reasons to sell. And we are staying the course and looking for long-term returns. So we're going to leave it at there today. Thank you for joining me. I hope everybody's having a good day. Feel free to contact us with any questions.